Hi, everyone. This is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is CEO of the McAlvany Group of Companies, and he's host of the superb McAlvany Weekly Commentary, a podcast I try to listen to basically every week. I've been listening, I think, every single week since 2009. David McAlvany, thank you for joining me again.
Jason, I enjoy being back with you.
Now, David, I want to ask you about these academic books and papers and op-eds that are coming out recently about cashless society, the war on cash, the war on savings, financial repression, negative interest rates. We have Ken Rogoff, who just released a book called The Curse of Cash, and he's echoing Larry Summers, and they're talking about, getting rid of $100 bills and even, I think, $10 and $20 bills now. And then we have a Bloomberg op-ed piece from another academic Keynesian economist, and he's saying something that just really befuddles me. He's saying that the free market actually wants massive negative interest rates. What's your opinion of what these academics have been putting out in terms of their white papers and their books and their articles lately?
I think there's two things we have to keep in mind. One is that there's an ego story here, and that is that the PhDs who are looking in theory at very elegant solutions to economic problems are not really touching base with the real world very often, and they don't care what the consequences look like in the real world or in the economy, because again, ego is built into the PhDs that they've received and the theories that they're promoting, and they simply can't be wrong. They can't be wrong because what would they do with themselves if they were wrong? That is the second point. Is that's reflected well in Thomas Kuhn's book, The Structure of Scientific Revolutions, where he says people begin to think like a group, and they cluster around a certain idea. They defend a certain idea, a certain interpretation of reality, and it doesn't matter if there's contradictions. It doesn't matter if there's problems that can't be solved with that existing theory or what Kuhn called a paradigm. And then all of a sudden you have this cropping up of different events or different problems which cannot be explained by the current paradigm, and ultimately there is a massive revolution. That's what he talks about in The Structure of Scientific Revolutions, and I think that's what we're on the edge of, where academics and PhDs are flogging monetary policy, and they're not paying attention to the fact that it's not working. And so rather than say, hey, what we've done for the last 7 or 8 years has not created economic activity, yes, it's created asset price inflation, but it has not created economic activity. Let's not review the frailties of our theories or the misconceptions in the assumptions we make. Let's just do more of the same. And that's what Rogoff is talking about, basically taking what has been negative real rates when you factor in inflation and now suggesting that nominal rates, negative nominal rates, are the way forward. Well, look, you and me, Jason, we're not going to put up with that. If you've got money in the bank and you're going to be taxed to have that deposit just sitting there, you would opt out. You would put money in the mattress. And that's why Rogoff has said, basically, you have to get rid of cash if you're going to continue to implement a long-term policy of negative interest rates, to close the exits and keep everyone contained in this universe where we will extract as much money as we need from them in order to create economic activity. It's a bad idea, and again, I think it boils back to those two things. There's an ego story here tied to their PhDs, and there's a reality which they're not aware of yet, which we're on the cusp of a major revolution in the context of finance and economics.
I also think a lot of them are apologists for the big government, and then they keep doubling down on the policy. So it's like what Paul Krugman says: "Oh, we didn't do enough of this policy. That's why it didn't work." But you just released a great interview today for our listeners out there. Go to McAlvany Weekly Commentary and listen to the Carmen Reinhardt interview. It's over an hour, so it's at length. But she talks in there about financial repression and also about how people's taxes are basically going to go up. And, the policies that are going to be done going forward by pretty much every single government on planet Earth, they're going to be very heavily tax dependent. It's just pretty amazing the funny things during that interview that she was talking about. You asked her about, a currency war and competitive devaluation, and then she started quoting basically Ben Bernanke's paper that, if everyone's trying to devalue, then it's not a currency war.
Well, right, and it's also imperceptible in terms of all currencies going down, let's say, on a series of escalators at the same time and at the same pace. you're not going to see it. It's not going to look like devaluation, but where you'll feel it is in real terms when you go to buy goods and services, because the producers of real goods, the providers of real services are going to remark the value of what they provide to a new market rate as the value of all currencies, which again may imperceptibly go down. That's where the adjustment will be. And in that interview, she basically says this is the potato chip theory, where you've got a bag of potato chips. The size of the bag doesn't change. The price of the bag doesn't change. But the amount that's in there, the number of chips in the bag, that does change. And that's what we're talking about. I think she was very candid in saying, look, one of the things I count on is having to save more, because taxes are going to go up, and we don't necessarily know how or how it will be hidden, because there's lots of ways to increase taxes. Some of them are official through Congress, and others are very surreptitious and very hidden. Nevertheless, what I must do as an individual is recalibrate how much I have to have in savings, knowing that the cost of goods and services 2 years from now and 10 years from now and 20 years from now is going to be considerably more than it is today. So prepare accordingly. That was an interesting conclusion she came to.
Yeah, the potato chip theory, I don't think it's a theory, David. We've had so many food companies admit that, they're doing shrinkflation, is what the term that Dr. Pippa Malmgren coined, and then it's in her new book, Signals, which I also recommend our listeners go and read, and talking about in there. And, these food companies, they have higher input costs, so they're going to keep the price the same. They're going to reduce the portion size. And that's just a way that they can stay in business. Some people who don't like capitalism are going to think, oh, it's these evil, greedy companies, they're going to do whatever they can to make extra money, but, they have to maintain their profit margins too, or they're going to go out of business as well.
That's right. That's the circumstance we have in shrinkflation. You're right. It's not theory in the future. It's a real-time reality.
Now, you also had a recent guest, too, about GDP data. And, one of the other things that really irks me with the Keynesian academics now that go on TV, whether it's Stanley Fischer or Janet Yellen, they say negative rates are working in other countries. They also talk about full employment. In the real economy, in Main Street, in the United States, I don't see examples of full employment. I see a lot of people that have a couple degrees that just graduated college, and they're servers, they're bartenders, they're Walmart greeters. They're taking whatever job they can find, if it's a couple part-time jobs, and trying to piece a life together. And we have these academics going on TV and releasing government numbers saying that means the economy is good.
Well, and this is just part of a larger narrative, which is that government takes certain statistics and uses them as political tools to communicate a particular theme. It's no accident that the Obama White House took control of the Census Bureau and brought it in underneath the White House for its organization in 2009. And, lo and behold, what do we have? A redesigned set of income questions relating to income that was done for the survey in 2013. And, whether it's GDP on the one hand, or statistics coming out from ABC News this week that we've just set the record for the fastest household income growth ever recorded, rising 5.2%. Well, there's a problem with that. That's what the Census Bureau can tell us, and that's how the headline can read. But if you look at tax receipts, official tax receipts, you don't have anything like that kind of rise in income. So they've been able to massage the statistics to tell a particular message. And keep in mind that this is now in an election cycle. It's very convenient to say, look, things have never been better. Oh, would it be the established party, those who hold the White House today, that would like that message to carry so that there's continuity from one term to the next? Of course. It's no different. It doesn't matter if you're a Republican or a Democrat. The reality is statistics are abused by both parties when they have the opportunity to. And it's incumbent upon you and me, Jason, and upon your listeners to really look at that and say, beyond the headline, whether it's GDP growth or income growth, household income growth growing at 5.2%, understand that it's assumed that you're a patsy and you won't think twice about what you're fed. And the beauty is, you do think twice about what you're fed. You do think twice about what goes into those statistics, and you're better for it. You understand the world as it is versus the way they want you to see it.
Yeah, I've heard stories of past U.S. presidents, whether it's Lyndon B. Johnson or others, getting the GDP numbers ahead of time before they're officially announced in public and saying, these numbers don't look good, retweak the formula and release it so we can show some growth here, do whatever you have to do. So, I mean, it's both parties who are doing this. When I read stories, though, David, about purchases of safes in Japan and Germany to hold cash because, private banks are starting to charge interest rates on depositors, which are negative interest rates for private banks. And then I read how, large institutions who have billions of dollars in cash, they don't want to hold cash at large banks anymore because they're going to be charged interest. They want to set up, basically their own warehouse of cash outside a banking system and hire security guards and stuff. This is a dystopian type of future here, and the policy decisions that these academics like Carmen Reinhart and so many others are making, they're going to have a lot of unintended consequences, I think, that none of the Keynesians in power are planning.
Well, and it may be that over the next 10 years we see the undoing of the banking system as we know it. I mean, you've got all of your CEOs at the major banks saying, look, we've got to raise rates, we've got to get out of the negative territory, it's killing us. And, their net interest margins are suffering. And, to survive, they would like to see higher rates. But the reality is the system can't pay the interest component on the amount of debt that is in the system today without there being a major cash flow crunch. And that's corporate cash flow, that's individual cash flow, that's the central banks. I mean, you take our $20 trillion in debt. I'm sorry. I mean, it's less than a 10% line item if you're looking at our fixed costs of operations as a country, but you raise interest rates very much. Let's say you go to 5% as Carmen Reinhart suggested in our interview. Great. All right, but 5% on 20 trillion, now all of a sudden you're talking about a number that is one of the largest single line items in our budget. Can we do that? Is it realistic? That's where the academics need to check what is actually doable, theory aside, what in practice will actually work. We are undoing the financial system by keeping rates at this low level. We have no idea what kind of malinvestment is, well, I guess we do have some idea of the malinvestment that's occurring as a result, but we don't have any idea what the consequences will be of that malinvestment. People taking more risk, people trying to go after the magic 5%. They've saved decades in anticipation of retirement, hoping that their savings would supplement Social Security and pension funds. And they're not getting anything in their savings. So what are they doing to accommodate? Moving to high yield, moving to much higher risk assets in order to get what they must have to pay the bills. What are the consequences of that, Jason? I think you and I know it's not going to end well.
Yeah, I completely agree. I think all the policy decisions, David, are being done just to delay the collapse as long as possible. And, that's what I heard from my source who was at the IMF meeting in 2014 about the currency swaps, that they know that the collapse could happen at any time, and they're just trying to delay things as long as possible. 5% increase to interest rates. If interest rates won't normalize, in my opinion, but if they do somehow, I mean, I think that would blow up pretty much the entire financial system. We have, all these over-the-counter derivatives and interest rate swaps that couldn't handle that because the banks don't have the collateral to pay off the bad bets. We have banks that have made, other bad loans to oil companies. The shale oil companies couldn't pay higher interest rates. So there's so many, and we have the government debts, now that are, we have over $12 trillion worth of total global debt that's in negative interest rate territory. None of these things can handle higher interest rates. So I think, they're going to try to keep things extend and pretend as long as possible close to 0% interest rates, because then the governments can continue to borrow more and more money and they don't have to pay those interest payments. So I think the central banks are trapped. Do you think the central banks in Japan and the ECB and England and China and also the Federal Reserve are trapped?
They're very trapped, and we're actually seeing some things in the markets in the last few days which are very disturbing. You've got the Japanese government bond yields which have risen sharply on the long end, while short rates have gotten even more negative. And that's not going to end well. That's not going to end well, and it's going to have a major impact on the global bond market, not just the Japanese government bond market. It's simply not going to end well. I had an interesting conversation with my cousin who operates a mortgage business in the Southeast, one of the larger mortgage companies in the Southeast. And he said, Dave, our business is going very well in a low-rate environment. Our company has grown considerably. I would consider us a fairly large business today. He said, but we're 100 basis points away from being a very small business. And that's the reality. You raise interest rates 1%, and my cousin is operating, in an office with 3 people instead of 1,000 or what have you. There is a dramatic impact across the economy if you begin to raise interest rates. You're correct. They're trapped.
David, I don't see how we can have, people like Janet Yellen at her Jackson Hole speech say that, the economy is doing well, and then also talk about both, totally contradict herself and say if there is another recession that they can expand the balance sheet. It doesn't seem to me that both things can occur at the same time. So she's not telling the truth then. It's like, I think it's more, of a political speech to people that, we have our asses covered. Because look at the amount of money that all the collective global quantitative easing that all these central banks are putting in. It's over 180 billion per month now, and I don't see any sign of this decreasing.
Well, you're right. They're trying. You can take that two ways. They are covering their assets. They are covering their assets and making sure that they don't see devaluation in their assets, because you're talking about a diminishment in collateral and a radical change within a very leveraged system. Think about that. If you have a change in the value of assets, that is collateral on a lot of debt. We have an over-leveraged system, and that's where you can begin to see the whole financial system collapse. So yes, it's incumbent on them, and they see it as their job to maintain the status quo. If things are going so well, Jason, if things are going so well, why are we still on monetary policy life support? I mean, we should have backed off from this 2 years ago, 1 year ago, 3 years ago, 4 years ago. It's Bernanke who was telling us there was green shoots in the economy and they were ready to normalize, and he laid out in 2012 an exit strategy. What happened to the exit strategy? We haven't implemented anything. What people have to appreciate at this point, again, what we said earlier, they're being treated like patsies. Okay, and the messages and the messaging is very deliberate. It has to be, because the reality, the economic fundamentals, which have continued to deteriorate, even while stock prices have moved higher, that decoupling, again, it feels good if you're on the asset side of the equation and you've seen appreciation in your assets, but understand there's more risk implicit to the financial markets and to the stock market and to the bond market. Probably since 2008, since 2000, you could come up with a couple of historical parallels, which I think would suggest that you really don't want to be taking very many risks today.
Yeah, and Paul Volcker and Alan Greenspan and Ben Bernanke are being a lot more honest after they leave the Federal Reserve. I think Ben Bernanke admitted in a private dinner with David Einhorn. Obviously, Einhorn's a billionaire, and so he can afford, I think, to pay Ben Bernanke's $250,000 consulting fee. That Ben Bernanke told him interest rates won't normalize in their lifetime. So I mean, the stuff that they're putting out in public for most public consumption is totally different than what the insiders are being told the truth about. I have 2 listener questions I want to get to before we change topics to gold and gold stocks. One of them is from Clint, one of our listeners. Why are you so bearish on the long-term future of China?
Well, it's an issue of what is financing growth, and today it's government operations that are financing growth. It's not broad-based consumption trends. You don't see what has to happen for China to really roar into a new growth phase. I think when you're looking at the amount of debt that is in the Chinese market, these are not new figures. But you're talking about relative to GDP numbers that make our debt look like child's play. The question is out there: does it make a difference if you're in a command and control environment where the government is going to absorb all the losses and the market can be muted? I mean, I have a friend who's an economist in China. He had 10 million people following him on Twitter, and he said some things that were mildly controversial, and the government shuts down his Twitter feed. He's gone. So you can control the flow of information. You can change market dynamics at a whim. So is there then the case that you can borrow excessively, invest in a reckless fashion and not see a consequence to it because you're in a command and control economy. Well, I would suggest to you that central banks have in the developed world outside of China, they've nationalized the stock and bond market, and yet you can still ask me a question, am I concerned about there being a revolt in the bond market and the stock market with significantly lower values in both? And I'd say, yeah, well, for the time being, central banks are in control. And you might say, well, the PBOC, the People's Bank of China, will control the outcomes in China and there will not be a catastrophic decline. And I'd say, yeah, you're right, and it'll work until it doesn't. Because that's what we're playing with in the West, too. Central banks have nationalized the stock and bond markets, and that's going to work until the bond vigilantes show up again or until there's enough liquidity coming out of the stock market that central bank operations, overnight operations, can't keep up with it. And I think that's a very real possibility as we head into 2017. Keep in mind, 2017 marks a unique period. If Trump gets elected, and I think there's a very high probability that he will get elected, you're looking at another transition from Republicans to Democrats. We had a transition in the year 2000 from Democrats to Republicans. And note, between September 1st and December of that year, you had about a 41% decline in the S&P 500. Fast forward to the baton being passed from from Bush to Obama in 2008, you get the NASDAQ 100 shedding roughly 45 to 48% in the same time frame, sort of a September to December time frame. Why? Why was there major declines in the equity markets as the baton was being passed from one administration to the next? It's because new policy uncertainty in the first 2 years of a fresh administration with fresh ideas leaves the market practitioners and market investors saying, we don't know what the outcomes are going to be. We don't know what the implications are going to be. So for the time being, we'd rather move to the exits. And they do it en masse. We could have that now. In spite of a central bank fix in the marketplace. We saw a central bank fix. We saw active manipulation this week in the stock market. Look at Monday's action. I mean, here's how it plays. What did we have on Friday? We had the suggestion by Rosengren that there was going to be hikes. That was Friday. And the market started to fall apart on Friday after Rosengren's suggestion that hikes were nigh. Okay, so when we had bonds falling, stocks falling, and commodities all sliding at the same time on Friday. Halfway through the day, an unexpected, unannounced speech is going to be given Monday morning by Lyle Brainerd, who happens to be one of the more dovish voters at the FOMC. Okay, so Brainerd comes out on Monday and says not to worry, gives us very dovish comments, and we've got a massive rally on Monday. I mean, come on. And actually, before the market opened on Monday and before Brainerd's comments, you've got massive hikes in the SPZs, your futures contracts for the S&P 500, pushing prices up before the open, creating some positive momentum. Is that the plunge protection team? I believe so. So we're going to have central banks in our part of the world and across the pond continuing to intervene as long as they can to perpetuate a sense of normality and keeping us from there being a consequence from bad policy choices made thus far. How long does that last, Jason? I don't know. But I think that's what you're dealing with in China, is you can suspend reality for a certain period of time, but there is ultimately going to be a consequence to the amount of debt and malinvestment which has occurred in China. Is that a 2017 event? I can't tell you that, but I do think it's on the horizon.
Yeah, I think timing this is almost impossible, getting perfect timing on this. But I mean, welcome to dystopia. We have global plunge protection teams in basically every major economy now, worried about asset prices falling, because then the collateral goes bad. Then we have a chain reaction of derivatives market problems and so many other things. My next listener question is from Rich, and this actually goes, what does a global economic reset look like in your opinion? What does it do to wages, prices, and mortgages?
A global economic reset, I mean, you're really talking about who's going to pick up the bill. And so it's really a question of politics more than economics if you think about your power players deciding who's going to pay the bill. On the one hand, if you say it's going to be via inflation, and the debts that we have are going to be paid off more aggressively with running a higher rate of inflation, then it's the common man who's been designated to take the hit. And it's your asset holder and you're very politically connected who've said, look, we got to keep the banking sector intact as much as possible, and we don't want to see massive defaults. So we're just going to flog the common man, flog the middle class, and hope that he doesn't notice, us running a higher rate of inflation. That's one again, it just boils back in respect to Rich's question. It boils back to politically, who are they going to designate to take the hit? We had something similar happen back in the 1960s when officially we announced the war on poverty. Well, now you've got this massive disconnect, probably the biggest disconnect or gap, if you will, between the rich and the poor since the days of the robber barons. And we will have the equivalent of the war on inequality. We will have that over the next 5 to 10 years. And so if you are an owner of assets, a part of the global economic reset is going to be, particularly if someone like a Clinton comes in, or that ilk, the more leftist ilk comes in globally. And I mean, I'm not picking on Clinton here, because there's a host of left-leaning groups around the world, whether it's the Five Star Movement in Italy, the National Front in France, Podemos in Spain, Syriza in Greece. All of them would love to fleece the rich to pay the poor. And again, that's how you reset. You're reshuffling the deck. You're reshuffling the deck and saying, okay, you've got something, I have nothing, let's make it equal. So if you had assets, what does it make sense to do with them? It makes sense to get quiet. If you're the guy driving a Ferrari, you should have sold that 2 years ago. You should be driving a 5-year-old Toyota Land Cruiser or something that's just nice, gets you from point A to point B. It's reliable, but it's not flashy. You want to lower your profile considerably, because in the context of an economic reset, you have all of those movements which I just mentioned. Five Star Movement, National Front. I mean, think about the folks that were supporting Sanders, and some of the folks who are supporting Trump, but I'm thinking Sanders primarily. They'd be out for blood, out for blood. Give me. You've got more than you need, and I don't have enough. It's only fair that I get some of your stuff. You see, the mindset of redistribution, it's been inculcated into our educational system for decades, right? And it's a rising trend given the discontent and around the world. And this is not just a U.S. political issue. Populism is on the rise globally because we have weak economic variables globally. Why did we see Brexit in Britain? Well, come on. Britain ran the largest current account deficit since records began being kept in 1948, 5.2% of GDP. Okay, and people are saying, well, I can't believe this happened. The common man in Britain is getting squeezed, and he's saying, whatever the status quo is, we're done with it. We're going a different way. So you have these upstart political movements. They're all expressing discontent with the status quo. In the context of an economic reset, this is for Rich, in the context of an economic reset, you want to keep a pretty low profile, because that kind of populism breeds over into the kinds of things that you might expect to see in the French Revolution. You want to keep your head down. You don't want to be an academic. You don't want to be wealthy. Even if you are wealthy, you don't want to show it. These are the things that I think about when I think about a reset.
Yeah, it's going to be very volatile going forward. There's a lot of social problems now in the U.S. I think that there's been a lot of class warfare, age, gender, race, and I think, a lot of it's been caused by the elites, like George Soros spending a lot of money, so we fight amongst each other, while, the elites just plunder us more with more inflation and taxes, and then, they pass these crony trade deals. They try to get like the TPP or whatever the new deals are called, so they can steal from us more. And then, most of the industries now in the United States, there's whether it's big pharmaceutical companies or the Federal Reserve, there's just so much cartels and basically hardcore fascism there. I want to ask you about gold in the rest of the interview. When I hear these academic economists like Larry Summers talk about a $2 trillion infrastructure program for jobs, even more misallocation of capital, that money's going to get into the real economy maybe and start causing more inflation, more than the inflation we already have now. Why do you think the gold bull market restarted in December of 2015?
I think you're seeing a growing audience of investors who are saying monetary policy is not working. And if it's not working, then ultimately we have to face up to what the economic fundamentals are telling us and what are the implications of that. If asset prices have disconnected on the basis of monetary policy, then implicit to the financial markets, there's a tremendous amount of risk. And how do we hedge that risk? You know, you ask a Stanley Druckenmiller, how do you hedge risk? And he says, I don't hedge risk. I just get out of the market. If I don't like it, I'm not going to try to hedge it because that assumes that there's a normalcy in the marketplace and relationships are still working. I assume nothing works in the context of chaos, which is why I'd like to be out completely. So when you look at that and you look at the movements in gold, including Stanley Druckenmiller coming into gold this last year, 300 million plus personal assets into it, why? Why? It's because there's suspicion that the system is not working. And to the degree that you have all your eggs within the financial system, you may very well be corralled and used as a part of the solution to a broken system. In other words, you could get squeezed beyond belief. So maybe have a few of your eggs out of the basket. And that does mean gold. Gold is one of the only financial assets that allows you to remove counterparty risk. It allows you to, yes, have a financial asset, but no, not be dependent on the financial system and sort of status cooperation. So I think we continue to see a major move into gold over the next few years, and it is a no-confidence vote. From this point forward, you're looking at gold as a no-confidence vote on central banking, on monetary policy, and frankly, on politicians' ability to create utopia for us. No confidence vote. It's a no confidence vote. You already know this, but the gold market is in relative close balance between supply and demand. Let's say on average there's 3,000 tons produced. There's roughly 3,000 tons that are used for industry purposes and jewelry. And of course China and India make up the vast majority of that, but China, India, the rest of the world, World Gold Council puts together interesting numbers on this, but it's just about in balance. The swing vote in the gold market is the investor. And if the investor is negative, then there's just enough liquidations to drive the price lower, even though you're almost close in terms of supply and demand dynamics. A little bit more buying by the investor, you're also the swing vote to drive prices higher. What people don't appreciate is how far and how exponential the moves can be in something like gold and silver, where you have radical supply and demand inelasticity. Just because demand increases doesn't mean that you can get more of the product. That's one of the reasons why miners tend to catch a pretty significant interest at this stage in the game, and I think will do very well over the next 2, 3, 4, 5 years. But that's like your call. If you want to buy a call option on the demise of central banking, then own a few gold shares. If you want an insurance policy on the demise of central banking, then own some physical metals outside of the system, because you may not be able to collect on your call options should the system collapse. That's in a nutshell my approach in terms of an aggressive position in the miners as opposed to a conservative, more insurance-oriented position in the physical metals. So that's been our approach both in our asset management business as well as in our precious metals brokerage business, which as you know we've been doing for close to 50 years.
Yeah, David, there's a lot of money managers who aren't actually allowed to buy physical gold. So they can buy GLD or they can buy gold mining stocks. So the gold mining stocks then basically act as a proxy. So they look for the most liquid ones if they're a large money manager and so on and so forth. But I think, what we're seeing, I don't know if you saw this news story, but did you see the Swiss Central Bank and the Bank of Norway now own over $1 billion each of gold and silver shares? So, these are central banks that don't own really any physical gold. In the case of Switzerland, they've been selling a lot of it for a long time now. It's just very interesting that they've been accumulating large positions in gold and silver shares now for the past couple of years.
Yeah, again, I think it's a call option on a certain outcome, and does it make sense to have some of that? Yeah, I think it's also an option that doesn't expire, unless you're talking about a very marginal producer. But you just never know. No, I think central banks are, interestingly enough, Ken Rogoff, who's a champion of the cashless society, is encouraging emerging market central banks to, for the sake of their own financial stability, diversify more and more into physical gold, which is kind of an interesting. I'd like to have him on the on our commentary, just to flush some of that out, not only his positions on the cashless society, but also to say, okay, how is it that you think gold ownership is justified by a central bank? What does this look like? Because you're talking about reducing other assets, which would include dollar assets, in order to increase gold holdings. Tell us the value and the justification for why you would make that recommendation. He's making the recommendation, and emerging market central banks are buying gold, as you say. There's other proxies for that too. Norway, Swiss central bank in the world of mining shares may do that to a smaller degree.
Now, I get asked a lot by my listeners, what targets for gold and silver price do I have? I don't think it's very smart to do that, especially in the long term, David, because I don't know when these central bankers are going to stop doing crazy things. You know, we have central bankers who want to devalue currencies, who want to do financial repression, negative interest rates. I don't even think anyone had even heard of them prior to a couple of years ago. They weren't ever taught, I think, in any normal business school or textbook. So we're in totally uncharted territory here. So when people ask me for price targets long term on gold and silver, I tell them, well, when are central banks going to stop doing crazy things, devaluing currencies and creating inflation? And when are, you know, government bureaucrats, because I think bureaucrats actually run most of these countries now more than politicians. When are the bureaucrats going to stop blaring on extra taxes that are coming down the pike as well?
Yeah, I think you're right. I mean, if you're going to pick a price, don't pick a time frame. If you're going to pick a time frame, don't pick a price. If you're picking both, you haven't been around in the financial markets to be humbled enough by those two variables being impossible to choose. So let's not talk in terms of prediction. Let's just think in terms of a thought experiment. Okay, so a thought experiment, and let's borrow from the past. Gold was suppressed from 1933 to 1974. January 1st, 1975, it was legal to own gold again. The price was $35 an ounce. We began a generational bull market. We started from 35 and we went to 190. 190 was the level that it reached by 1974. Just a few years later, 71 it actually started trending up. 74 you could actually own it. 190, it slips from 1974 to 1976 to 105. I think it was 104.60, but we'll call it 105. Then it goes from that 2-year correction phase where it got basically chopped in half to 875. Now, fast forward to the current time frame. We went through a two and a half decade bear market in gold. We averaged roughly $350 an ounce. We march over a 10-year period to 1900, some zigs and zags along the way. We go through a 4-year correction that takes us to 1050. Now, the question you're asking is, where do we go from here? Notice that the only difference between the 70s and now is a zero. 35, 190, 105. Fast forward to the present, 350, 1900, 1050 on the low as of December 2015. Is it unreasonable, and again, not a projection, not a prediction, just a thought experiment, is it unreasonable to think that gold could see 8,750 as, well, lo and behold, over the last period of time, 1980s to the present, we have seen monetary aggregates expand by greater than tenfold. Is it unreasonable to take that tenfold expansion in monetary aggregates and just add a zero to the price of gold? We've seen a pretty interesting pattern from 350 to 1900 to 1050. I'll tell you this: as I move closer to a prediction, I think 3,000 to 5,000. Those are easy numbers. Those are easy numbers. Anything above 3,000 to 5,000 becomes speculative, and we could get there very easily, given the dynamic that we talked about earlier, Jason. It's the inelasticity of the market. If there's not enough demand, if there's not enough supply to make up for exponentially increasing the demand, guess where the difference is made up?
In price.
Yeah. In price. So I think, frankly, you and I don't have the imagination. We don't have the imagination for gold moving to levels that it can and probably will move to. Yes, we want to protect some reputation, and no, we don't have a particular time frame because none of us have a crystal ball. But to assume that monetary aggregates have increased by tenfold, that global debt has increased 10, 20, 30-fold, I mean, massive increases in the amount of leverage that's in the financial system. Is it unreasonable to think that, oh, by the way, since the 1970s, guess what else has more than doubled? Global population. Global population. So there's a few more people who might, under the right circumstances, consider owning an ounce, and there's not enough ounces to go around. There really isn't. So I think we could see considerably higher prices, and the problem is the other side of the equation. Very high gold prices mean a lot of pain in the financial markets elsewhere, and probably a lot of government squeezing going on. And I'm not sure that as we don't get to those higher prices, the government doesn't start to make some radical moves against the gold market. I don't think confiscation, but windfall profit taxes and things of that nature certainly should be kept in mind. So, how to navigate these waters ahead is going to be tough. Is going to be very tough. And that's one of the things at the interview with Carmen Reinhart. One of the things that she said is you can never underestimate the power of government to get done what they think needs to get done. And let me tell you, I did an interview this morning with a guy who was one of the traders with the Hunt brothers back in the 70s. He was there when the FBI marched in with guns drawn, forced everyone out of the office into the parking lot, and then marched off with all the computers and all the records.
Wow.
Okay. When the government wants to shut something down, they don't have to play by the rules.
Yep.
They don't have to play by the rules. So I am all for owning gold and silver, but I think you have to be judicious about when you sell it, and I don't think you should necessarily be holding on for the highest dollar, because by the time we get to the highest dollar, you may have crosshairs on you as an investor, disadvantaged by government policies or underhanded bare-knuckle techniques, which may steal the crown of victory from you. If you're thinking you're going to collect your laurel wreath for finishing the race and finishing strong, it might not happen that way. So be aware that the rules can change on you very rapidly, and you've got to think outside the box. Just as outside of the box as it is today to be thinking about owning gold and silver, you need to also be thinking about outside of the box in terms of liquidating a gold and silver position at some point in the future.
Yeah, I completely agree. We've seen so much evidence of this throughout history that the politicians are going to change the rules. The kick is already up in the air and they're moving the goalposts. It's not fair, but this is how frustrating life is for trying to manage money right now and protect yourself from inflation and taxes and trying to get, a return on your savings at this point. It'll be interesting to see if, the SDR, the special drawing right, is part of the new global economic system in the near future, or if gold plays some type of component. But I think if the gold price does go to that potentially thought experiment number of 8,000 or more, the politicians are going to look for scapegoats. Obviously nothing has been solved since 2008. The banks have made a lot of bad bets. The central banks have done really stupid policy, in my opinion. But, if the gold price is at that level, they can go on TV or on in whatever media and go and blame the holders of gold for the problems in the economy, even though, people who bought gold were trying to protect themselves. They didn't create any of the problems, but they're probably going to get blamed for it, unfortunately.
As we move towards wrapping up, Jason, one thing I just want to encourage your listeners with is there's some major macro issues, and some of those macro issues, it's not clear whether it's public policy issues or economic growth issues or asset allocation issues like we've just been talking about. Not all of those can be solved, but I want to encourage your listeners that there are micro decisions that they can be making which will have a radically important impact for themselves and their families. In November, I'm releasing a book called The Intentional Legacy. I've been working on it for 2.5 years, and I'll be happy to send you an advanced reader copy if you'd like, Jason. But for your listeners, it'll be available on the newsstands November 7th. And the intentional legacy is basically suggesting that legacies from in a family context, and even at a national level, they're not lost or squandered because of broken bank accounts, but because of broken relationships. When you look at what you're building your life towards, understand that the most significant things that you can be investing in are not necessarily changing the world via Washington, D.C., or changing the world via influencing Hollywood and the movie picture scene. It's changing the world right under your nose. the world right under your nose. It's continuing to grow intellectually. Are you investing in your own library? That is a resource that you can manage, and it doesn't matter what our country or the world looks like from an economic or political or social standpoint 10 years from now. You're in control of managing your intellectual resources. You're in control of managing your spiritual and emotional resources. And by the way, as you do that, and as you intentionally design a course towards maturity, guess what you're doing? You're creating the structure that allows for real legacy transfer to occur. Broken relationships are the cause of broken legacies, not broken bank accounts. And so, again, we may be talking about major macroeconomic trends that may pressure the bank account side of the equation. I'm suggesting to you that there are individual choices, things that you can do every day, which are utterly empowering and will take you where you want to go in terms of your highest goals, your highest aspirations, whether that be monetary or in every other category where you're managing and stewarding resources.
Excellent. Well said, David. Well, I look forward to checking out your book. It sounds fantastic. If it's anything like the McAlvany Weekly Commentary, I think it's going to be a hit.
Well, I'll just say this: it's much more personal. I've never bared my soul quite that much. Personal examples and things that as a family we've learned through 50 years of asset management, both our resources and interacting with clients all over the country and all over the world. What we see is people who focus on the money side of the equation end up missing major things that are important in the midst of transferring identity and legacy from one generation to the next. So I hope it's helpful as people sort of reflect on the life that they want and how they can get it.
Excellent. Well, if our listeners want to subscribe to the McAlvany Weekly Commentary, how do they do so?
If you go to McAlvany.com, that's kind of our portal into every world that we have. McAlvany is McAlvany. McAlvany.com, that'll take you to our main page, and you can navigate to the commentary side if you'd like to subscribe, or look at our various other offerings. And as I say, as we move towards November 7th, we'll also have the book available if it's of interest to your listeners.
Excellent. Well, thank you for your time, and hopefully you'll be willing to come back on in another couple months and talk about how markets are going and get some more updates on your book.
Look forward to it. Thank you, Jason. Keep up the good work.